Estate planning can feel like this complex maze of navigating all these different terms and concepts, especially when it comes to ensuring that your spouse is financially secure in the future after you're gone. You might have heard of the terms of the marital deduction or QTIP trusts or QDOT trusts, but what do they actually mean? And how can they benefit you and your loved ones? In today's video, we'll demystify all of these estate planning terms, explaining how these tools work and how they can help maximize your assets while providing for your spouse, even in complex situations like second marriages or international families. So when someone makes a gift to a spouse or leaves that spouse money, and both spouses are US citizens, the unlimited marital deduction applies. So this means that spouses can give each other as much money as they want, or they can die and leave the other spouse as much as they want. So typically there's no estate tax exposure for a couple on the death of the first spouse. Everything just goes to the other spouse and the unlimited marital deduction applies. No estate taxes. It's postponed until the second death. So this applies in California to both community property and separate property. And it also applies whether this is your first marriage or second marriage or third marriage. And it applies whether you're a same-sex couple or a heterosexual couple. Note that this does not apply if you're in a domestic partnership or if you've been together with somebody for a really long time or you're not married. You really do need to be legally married in order for the unlimited marital deduction to apply. I've actually seen some couples choose to get married just so that they can get this unlimited marital deduction. Hey, whatever works.
Hey everyone, if you like my mom's video, like and subscribe.
Now, let's say that you want to leave money to your spouse when you die and you want the unlimited marital deduction to apply, but you want to control where the money goes upon your spouse's death. This frequently happens in blended family situations, and I discussed this further in my video, Estate Planning for Blended Families. So if you're in this situation, you can set up something called a QTIP Trust, which stands for Qualified Terminable Interest Property Trust. We're not talking about the Q-tips that you might put in your ear. It's an acronym. Now, there are several requirements for something to be a qualified Q-tip trust. The trust has to be irrevocable. It can't be changed by the surviving spouse or by anybody else. The surviving spouse has to be a US citizen, and the surviving spouse has to receive all of the income from the trust. And finally, the surviving spouse has to have the power to demand that the trustee converts non-income producing property to income producing property. So let me give you an example. Let's say that the Q-tip trust holds a plot of land that hasn't been developed, and so it's not generating income that would go to the surviving spouse. The spouse can demand that that land be sold and that the proceeds be invested. So then the spouse can start receiving dividends that are being generated by those invested assets. Okay, so you might be saying, hey, this sounds great. I want a Q-tip trust. I want the marital deduction to apply when I'm leaving money to my spouse, but I'm still controlling the terms when the spouse dies. But my spouse is not a US citizen. What do I do? Because as you know, for the marital deduction to apply, both spouses have to be US citizens. So there's really two options here. If the US spouse is making a gift during their lifetime to a non-US citizen spouse, the unlimited marital deduction does not apply, but instead the citizen spouse can gift a significant amount of money to the non-US citizen spouse. In 2024, that's $185,000 a year. Any amount over this would be subject to gift taxes. Now let's say that the US spouse, when they die, they want to leave money to the non-US citizen spouse. In this case, the federal government is afraid that when the non-US citizen spouse inherits the money, they're going to take the money and go back to their home country, and then the US government won't be able to tax that money anymore. So that's why they don't allow this marital deduction. But there is a fix in this situation. You can set up a qualified domestic trust or a QDOT, and that can receive the inheritance from the US spouse when they die, and the marital deduction will apply. So what is this magical QDOT? Well, first of all, the surviving spouse, the non-US citizen spouse, must be the only beneficiary of the QDOT. No one else can benefit from it. And then really importantly, at least one of the trustees of the QDOT must be a US citizen or corporation. That's what kind of anchors the trust in the United States. Then on the 706 form, when the US citizen spouse dies, the executor must elect on the estate tax return to treat the trust as a QDOT. And then every year, a form 706 QDT should be filed annually to report distributions from the trust. The non-US citizen spouse, as the beneficiary of the QDOT, must receive all of the income, and that income will be subject to income taxes, but not estate taxes. Now, the trustee can distribute some of the principal from the QDOT to the non-US citizen surviving spouse, but that distribution will be subject to estate taxes, unless the money is distributed for hardship reasons. Now, once the surviving spouse dies, the remaining QDOT assets will be subject to estate taxes, as if they were in the estate of the deceased US citizen spouse. So they're not considered part of the estate of the surviving spouse. This is basically a way to delay paying any estate taxes until the surviving spouse dies. Now, here's a workaround. If the US citizen dies and then the non-US citizen spouse applies for US citizenship and becomes a citizen before the deceased spouse's federal estate tax return is due, which is 9 months after the death of the deceased spouse, plus another 6 months for an extension, the now citizen spouse will qualify for the marital deduction. So just because the US citizen spouse has died, that doesn't mean it's too late to apply for citizenship. Okay, so hopefully that provides you some planning options between spouses, and it demystifies some of these crazy estate planning terms that we have. For more information or to see how this might apply to your situation, please feel free to reach out to our office. We would love to help you out.
Hello everyone. If you liked my mom's video, don't forget to like and subscribe. See you all next time.